Welcome to Aegon, and welcome to a short introduction to IFRS 17, which is the new standard to account for insurance liabilities. In this short video, we'll present some key choices that Aegon made on the implementation of IFRS 17. We'll start by having a look at the balance sheet, comparing the IFRS 17 balance sheet with the current and more familiar Solvency II balance sheet. While there are differences in scope, methodology, and nomenclature, the principles are actually very similar. For example, both frameworks follow the concept of best estimate liabilities. Where Solvency II adds a risk margin to cover for uncertainty of the product cash flows, IFRS 17 adds a risk adjustment for the same purpose. However, there are, of course, also differences. The contractual service margin, or CSM, is a new item and relates specifically to IFRS 17. CSM is a measure of the expected future profits, which is booked as a liability on the balance sheet under IFRS 17. Own funds under Solvency II and equity under IFRS 17 form the remainder of this side of the balance sheet. This is conceptually the amount of assets we hold in excess of the best estimate liabilities, risk margin or risk adjustment, and CSM. The CSM is one of the key reasons why the IFRS 17 equity is lower than own funds under Solvency II. However, CSM and risk adjustment are expected to be released over time as profits through the income statement. The lower equity stock leads to a higher earnings flow. Now we will take a closer look at how we get to these balance sheet components by looking at the corresponding cash flows. Let us start with the best estimate liabilities, or in short, BEL. In both the Solvency II and IFRS 17 frameworks, it represents the expected future cash flows such as premiums, expenses, and benefits related to the insurance contracts. The resulting annual profit forms the basis for the calculation of the CSM. These cash flows are then discounted, as to allow for the time value of money. Obviously, the discount rate is a key parameter for this. It needs to reflect the time value of money, the liquidity characteristics of the product, and market observable prices. For IFRS 17, Aegon chooses to use a risk-free rate and add an illiquidity premium to determine the discount rate. The illiquidity premium is derived from the implicit return of Aegon's own assets as reference portfolio minus expected credit losses. The expected future cash flows from premiums, expenses, and benefits are discounted and then added up to build the BEL. In Solvency II, a risk margin is added to the BEL to allow for the uncertainty of the product cash flows. IFRS 17 allows for uncertainty using a risk adjustment which is defined based on the BEL. For the calculation of the risk adjustment, Aegon uses the confidence interval method, a default choice under the standard. BEL and risk adjustment determine the expected profit, and therefore the CSM. If the total is a positive, this is a profitable contract. The expected profit is reflected on the liability side of the balance sheet as the CSM. This ensures that profits are not being recognized on day one, but over the duration of the contract. CSM and risk adjustment are recognized as profit on the income statement over time. Under IFRS 17, profit recognition is firmly linked to the duration of the policy and needs to reflect the services provided to the customer over time. Note, however, that the cumulative profit of the insurance policies does not change, since the cash flows do not change compared with the current IFRS 4 standard. IFRS 17 only changes the timing. In addition to experience adjustments for claims and expenses, CSM and risk adjustment releases are the core elements of the insurance service result on the income statement. There is one other core item that will impact the income statement structurally: This is the excess income from owning assets, in addition to the assets required to cover the liabilities. This income will be reflected as part of the net investment result. Obviously, this short introduction to the IFRS 17 income statement is strongly simplified, and there are many more elements driving profit and loss under IFRS 17. To summarize, IFRS 17 changes the way we present our IFRS balance sheet and earnings, but it does not change the fundamentals of our business. Within the possibilities of the IFRS 17 framework, Aegon has chosen to align the IFRS 17 earnings recognition as close as possible to the capital generation determined by the regulatory frameworks. In addition, Aegon strives to prevent earnings volatility caused by accounting mismatches. However, important to note is that the cumulative profit over the lifetime of the insurance policies does not change, since the cash flows do not change. IFRS 17 only changes the timing of the profit recognition, which is firmly linked to the duration of the policy and needs to reflect the services provided to the customer over time. In addition, the presentation of Aegon's IFRS results will be closer to an economic view, which should make it more intuitive to discuss the business using this lens. Thank you for your attention for this introduction to IFRS 17.